Right now, somewhere in a building you will never be allowed inside, a small group of people is deciding what your money is worth, not your investments, not your salary, your money. The dollars in your account, the purchasing power of every cent you have saved. And here is the part that most people never stop to think about. They were not elected. They answer to no government. And the decisions they make will ripple through every economy on Earth before you finish watching this video. This is not a conspiracy theory. This is just how central banking works. And once you understand the actual mechanics, you will never look at a paycheck, a mortgage rate, or a news headline the same way again. Let us start with a number. 8. There are roughly 8 major central banks that, between them, influence the monetary conditions for approximately 80% of global economic output. The Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, the Bank of England, the Swiss National Bank, the Bank of Canada, the Reserve Bank of Australia. 8 institutions, controlled by a few dozen decision makers at any given time, setting policy for 8 billion people. But even that overstates the diversity, because when the Fed moves, everyone else reacts. The dollar is still the world's reserve currency. It underpins roughly 60% of global foreign exchange reserves, and nearly half of all international trade invoicing. When Jerome Powell speaks, finance ministers in Jakarta and Nairobi adjust their models before he finishes his sentence. So you can really narrow it down further. 1 institution, 12 voting members on the Federal Open Market Committee, and, in practice, 1 chair who sets the tone, signals the direction, and moves markets with a single word choice in a prepared statement. 1 word, trillions of dollars in asset valuations. That is not an exaggeration. That is a Tuesday. Now here is where it gets interesting. Most people understand that central banks set interest rates. Rates go up, borrowing gets expensive, the economy slows. Rates go down, money gets cheap, the economy heats up. Simple enough, but the rate is just the visible lever. The mechanism underneath is something far stranger. Central banks do not just set the price of money, they create it, literally, from nothing. When the Federal Reserve wants to inject liquidity into the financial system, it does not print physical bills, it buys assets, usually government bonds, from commercial banks. And it pays for those bonds by crediting the bank's reserve accounts. Money that did not exist 5 minutes ago now exists. The Fed just typed a number into a ledger. Between 2020 and 2022 alone, the Fed's balance sheet expanded from roughly $4 trillion to nearly $9 trillion. They created $5 trillion in about 2 years. For context, that is more money than the entire GDP of Japan, conjured from a spreadsheet. And the rationale was reasonable. There was a pandemic. The economy needed support. Lending needed to keep flowing, fine, but here is the uncomfortable math. All that new money had to go somewhere, and it went, first and fastest, to the people closest to the source: large financial institutions, asset holders, equity markets, property markets. The people who already own things watched the value of those things increase dramatically, because more money was now chasing the same number of assets. Meanwhile, the people who owned nothing, who kept their wealth in cash, wages, and savings accounts, watched their purchasing power quietly erode. That is not a political statement. That is just how asset inflation works. The economists have a name for it: the Cantillon effect, named after an 18th century French-Irish economist who noticed that when new money enters the system, the people who receive it first benefit the most. By the time it trickles down to wages and consumer prices, its value has already been diluted. 250 years later, the mechanism is identical. We just do it at a scale that would have been incomprehensible to Richard Cantillon. Now zoom out. This is not unique to the United States. The European Central Bank ran its own version of quantitative easing for years. The Bank of Japan has been so aggressive with monetary expansion that it now owns an estimated 50% of all Japanese government bonds. The central bank is the largest single holder of the national debt of the world's 3rd largest economy. Let that sit for a moment. And what happens when these institutions get it wrong? When they hold rates too low for too long, inflation runs. When they tighten too fast, credit markets seize. The 2008 financial crisis was not just a banking failure. It was a regulatory and monetary failure. Rates had been kept accommodating through the early 2000s. Risk was mispriced for years. And when the correction came, the central banks stepped in to bail out the institutions they had failed to constrain. The people who lost their homes did not get a bailout. The people who caused the problem did. So here is the question nobody asks out loud in polite financial circles. If central banks can create money at will, buy assets at will, expand and contract the monetary supply based on the judgment of unelected technocrats, and if that power consistently tends to benefit asset holders over wage earners, then what exactly is the implicit social contract here? We talk about democratic accountability. We talk about checks and balances. But the institution with arguably the most direct impact on your daily financial life operates with a level of autonomy that no elected government could get away with. Is that a feature? Is it a bug? Or is it just a very old arrangement that has learned to dress itself in the language of expertise and neutrality? The next time a central bank makes a decision that moves your mortgage rate, your grocery bill, or your retirement account, remember someone made that call. A small number of people in a room with enormous power, and very little of it pointed back at you. The 1% of the 1% is not just a wealth figure. It is a governance structure. And it has been hiding in plain sight the whole time.